So in terms of the transitory for longer argument, you can see in the sort of oscillations in the markets that investors don't quite know what the answer is going to be, right? Are you hedged for longer than expected inflation within your portfolios?
Yes. So first of all, good morning. Yeah, I mean, absolutely. A few months ago, people were defined transitory as over the summer, and I think now we're, it is definitely a case of into next year. So the risk that that Soros is talking about of even longer than that are certainly something that we need to be mindful of, and obviously one way to play these sorts of things in current risk. Inflation scare is around energy. So this is one of the reasons that energy has been such a strong outperformer, and we've been balancing our existing portfolios with a bit of exposure to energy.
I think saying that energy is an outperformer is almost kind of downplaying it, right? By a very broad margin, let's put it that way, when it comes to energy stocks, compared to just about anything else. Is there further upside?
If we get oil over $80, and yeah, I mean, so it's all driven by earnings, of course, and earnings in the energy sector are coming off of really easy comps, and they're going to look strong for quite a while. And as you mentioned, especially relative to other sectors. So we think that energy could do well certainly through year end.
What other sectors are you looking at when we continue to see higher inflation, higher yields as well? We have seen really growth roll over and sort of catch up to value plays this year as well.
Well, for us, the sort of framework that we have is we think for the last 5 or 6 months, we've entered a period of kind of a mini cycle in the U.S. where you've got a changing, Fed regime, slowly but well telegraphed, and we're kind of, at the extended end of a recovery, and this sort of leaves the market vulnerable to, external shocks and increased volatility. So certainly that's played out, and probably even more than we would have expected. We've got some, I would suggest shocks from China on the regulation side, energy we've just talked about. So while we would expect positive returns over this sort of period, definitely you need to be selective. So to answer your question directly, we're looking to add selectively in areas such as tech, also healthcare, and obviously, as you mentioned, with rising rates up to 2.5 over the next year or two, U.S. banks are an obvious beneficiary there. So certainly we like that as well.
We heard from the Bloomberg Global Invest Conference that some of these Chinese tech names may be going back to Hong Kong or so. How do you play those Chinese stocks?
So for us, look, I think in the short term we have to be very careful because growth is going to be slower. It's going to be impacted by extra costs such as worker welfare, higher compliance costs for data, less pricing power from the market leaders. So in the short term, things are, it'll be slow for a little while. But we think this is really a reset. So after the reset is over, you would expect to see these especially stronger names looking at 20+% growth rates over time. So we think that there is going to be a period where the current common prosperity theme reverses back to the net tech theme, and we would be looking for opportunities there. So, but we also do think it's too soon in China